A preview of the latest active management report from Russell Investments Canada shows an outperformance by Canadian large cap managers in the second quarter. Not speaking well for my last half hour. The story behind that headline: only about a third of the big cap managers held Valeant Pharmaceuticals. Joining us in the studio, Kathleen Wiley, Head of Canadian Equity Research at Russell Investments. Thank you very much. I love this, going through all of these numbers. So let's get to the headline. Yep. It's Valeant. I mean, they continue not to own it, and it hurts them.
It does. Only 35% of managers in Canada hold it, and the stock was up 11% in the quarter. Not as much as the first quarter, but what happened going forward is going to make it even more challenging is it hit over 6% weight in the index. It actually overtook, I'm not sure if it is right now ahead of Royal Bank, but as the largest stock in the index. So I like to talk about this as the latest concentration issue for Canadian large cap managers. It does make it very challenging for them to beat the benchmark. So I was happy that 62% did beat it. You know, there were a couple good things. Gold stocks fell. We've talked about that. That used to be the big concentration issue, right? Shifts from one to the other. They fell about 4%, and managers are about 2% underweight, so that was good. Bank stocks were pretty strong. The three that are widely held, we've talked about this before, all outperformed, so that helped. And then the negatives were Valeant, and not a lot of sector breadth this quarter, so it was kind of, you know, two good, two bad things, and overall they did pretty well, I would say. So,
in your history of watching this data, and I think it's one of the concerns that what happens sometimes is that these managers are forced to participate in a name, and we haven't seen it yet.
Yeah.
But you know, how long does it take before they jump on board?
And you know what? That's something we're watching carefully, and it'll be highlighted in the release tomorrow. But it depends on the style of the manager. So you can forgive, or you're okay with someone who focuses on price momentum. So a growth type manager, 75% of growth managers already hold the stock. So, but if we start to see it popping up in value or dividend portfolios, it's our job to really question that, because it doesn't fit with their style. I remember, you might not remember this, but you might.
I remember
in 2007, RIM and Potash were accounted for half the index gain, and that was huge. And so suddenly, in early 2008, we saw it pop into some value portfolios, and that was just not a good thing. So we are watching closely. Now, you know, obviously there are some people who their style is more to be benchmark sensitive. And if that's the case, you know, that makes sense. So a market-oriented portfolio, those guys are more core. I don't talk much about them in this report, but it's okay for them to hold it. But so it really comes down to their style.
So it's important for an investor who's in any kind of fund to take a look at what is owned. I mean, you may be happy that Valeant's in there, but if you're a value, you know, you want to be in a value fund, you want to question that.
And you know what? And that's my job. Really, it's not actually doing this report. It's actually going out and meeting with investment managers and overseeing their portfolios and really drilling them about what they own and why they own it. So we will be watching it carefully. And I even highlighted in the report, you know, we saw from last quarter to this quarter, one growth manager added it. That's okay.
It's okay.
And one value sold it. So that's good. So, but we'll wait and see. It makes it interesting.
It certainly does. Another issue: value and dividend managers are lagging growth. We're seeing that in pockets in the U.S. as well.
Yeah. So, but for the fifth consecutive quarter, growth managers have outperformed value and dividend. I just think that this is what happens. You have one style in favor. Value and dividend managers did really well. Well, for most of the financial crisis, but really 2011 to 2013, they did great. And then the tide shifts, and growth managers didn't do well, so the tide has shifted more to growth. So this is why we promote, you know, a multi-manager style. You don't know how long this is going to last. So you might think, okay, growth managers have done well for 5 quarters. Is their time up? I don't know. It could last another 2 years. I mean, we can't predict which style is going to be in favor, and so have a mixture of all of them, and then they should offset each other, because they do perform differently. Even in Canada, where we have a lot of overlap in what they hold.
A couple of months ago, it might have been a couple of quarters ago, it might have been 4 quarters ago, you mentioned to me that Bank of Nova Scotia was the most owned of the banks.
Yeah, that changed a little bit. Now it's Royal.
No, I think it might be
TD. I'm sorry,
which I was actually surprised at that, because I always think about what's going on in terms of the people that come on here.
And what they talk.
And about a year or so ago, everybody was Scotia.
Yeah.
And now today they're TD.
Yeah, but you know what? To be honest, the difference is pretty small. It's 87% hold TD and 86% hold Scotia.
Yeah, no,
so
you're right.
it's just really widely held.
Yes.
And Royal is like 82%. I mean, those three big stocks really determine what happens. Overall, they're underweight the bank stocks, but that's because they're a 21% weight in the index, right? So it's what those stocks do. It's just like in energy, you can't just blanketly say it's good or bad for them. What happens in energy? It depends what CNQ and Suncor do, because they're really widely held. So you have to kind of dig beneath the headlines or the sector and get into the nitty gritty and looking at the stocks. So.
And I guess that will be an interesting dynamic for big cap managers as we move through this quarter, because we did see a rally in the banks, but through the month of July, it was kind of horrible.
Yeah. So when I last checked, as of yesterday's close, the banks were outperforming. The market is pretty much flat right now, actually. Whereas last week when I first did this, it was down 3%. So now the market's flat. Banks are outperforming. Gold stocks are down 21%, but our friend Valiant is up 24%, and so that is. So you got really good sector breadth, only energy and materials are underperforming, but it's really hard to tell right now how much of an impact Valiant is going to have on a manager's portfolio. It depends on how many stocks they own. It's really going to be an interesting quarter to see what happens.
So the financials may have been outperforming year to date, but they've given up a bit of a ghost in the month of July.
Yeah, but the three, really, I just pay attention to the three banks, and they were doing better than the index. That's sort of, I think, more in terms of, are they outperforming the index? So again, that changes day to day, right? So if they start to underperform, then that's going to be a negative for managers, and I would have to completely change my view. But
now, finally, you did mention Suncor and CNQ, sort of the big weights. What has the shift been like in terms of the energy space? Because everybody wants to focus on.
You know what? I think their managers are a little bit more underweight energy. They're holding less of it. So, but people are just. What they're doing within their portfolios is shifting the type of energy companies that they own. So they're making sure that they're not going to get killed if when the oil price continues to fall. So there's been just shifting, but with it overall a little bit more of an underweight in the sector, because there's just cautiousness, and nobody, in the long run, people believe that they will do well, but they just don't know right now, and so they're trying to make sure they're positioned for when it does come back. But not lose too much if it doesn't. It's hard. It's hard to be a Canadian portfolio manager. I absolutely.
Was 70% in financials, energy, and materials.
It's crazy. The concentration makes it extremely difficult for managers. But you know what? In the long run, they've still added value. The median is 20 basis points ahead of the benchmark over 10 years on average per quarter, right? And that first quartile manager, the more skilled, is 46 basis points per quarter. So you can't just say stay away from active management. In fact, I wouldn't want to have a 6% weight in Valiant if you hold an index fund, right? So it's tough, but they just stick with what they're good with and try to ride out these difficult periods, because they come and go. We know they come and go, right? Is Valiant going to keep going up forever? I'm not going to predict it, but
nothing does.
Nothing ever does. So.
Kathleen, thank you very much.
Thank you for
Always
having
good
me.
to hear your thoughts.
Thanks.
Kathleen Wiley, Head of Canadian Equity Research at Russell Investments. When we come back, we got Smart Jeans. Google and Levi's are teaming up.